Hi, I'm Scott Robinson, Director of the REIT Center at NYU Schack Institute of Real Estate. I'm fortunate to be co-hosting our fall REIT leadership series with my friend and industry colleague, Robin Panofka. Robin co-chairs Wachtell Lipton's real estate and REIT M&A practice with Adam Emmerich, both of whom have long supported the Schack Institute, notably as conference co-chairs of our annual REIT symposium held every spring in New York City. Today's conversation is with Ralph Rosenberg, partner and global head of real estate at KKR. Ralph joined KKR in 2011, leveraging his incredible career to build a powerhouse real estate platform with $64 billion of asset under management. I'm very appreciative of him sharing his time and insight about the economy and real estate, as well as providing career guidance for our students. I also want to thank the many NYU Schack students who participated in this series, including today's co-host, Greg Rudman.
So we are thrilled to have with us today Ralph Rosenberg, the global head of real estate at KKR. KKR now has 65 billion of AUM, 165 professionals across 15 cities in 10 countries, and has grown dramatically under Ralph's leadership. And that's part of what we are hoping to talk about today, is how you did that and how you keep it going in this challenging environment. So maybe let's just start with a broad discussion of strategy. Looking at your presentations, website, et cetera, you have multiple strategies pretty much across the capital stack. And I guess the question that might be helpful to start with is, how do you employ each strategy? Which part of the capital stack do you invest in? And does it vary kind of in COVID and now in this new environment we're in? How do you think about all of that?
Sure. So first of all, it's great to be here, and thanks for inviting me. Robin, in order to answer your question, we need to take one step backwards and just talk about the design of the platform and the growth of the business over the last 11 years. And that will inform the answer to your question. So to take a step back to March of 2011, when I joined KKR, at the time, the firm had no real estate dedicated AUM. All the real estate activity that the firm participated in was done through the private equity funds. And that was more episodic and more, related to effectively the RTC days, that kind of stuff. And coming out of the global financial crisis, Henry Kravis and George Roberts really felt that there was a really unique opportunity to effectively become a global dominant player in the real estate GP business and to consolidate their relationships that they had in private equity into other alternatives, including, of course, real estate. So I give you that background to say that when I joined the firm, we had a blank sheet of paper to build the franchise off of. And there were a handful of like golden rules that we agreed to up front. One rule was that all debt and equity related to real estate would feed through me, so that there was no conflicting pool of capital outside of a pool that I was responsible for that would inadvertently cause channel conflicts with market intermediaries, inadvertently compete against a pool of capital that I controlled. And so culturally and architecturally, everything that touches commercial real estate, debt or equity, falls into my business unit. And so for those of you, a couple of us are old enough on this call to remember this, I best analogize that to like the best of Lehman and the best of GE Capital, where the same people sat in the business unit, and it was really all about dominating the capital stack across credit and equity and being nimble to be able to shift across pieces of the puzzle. The second golden rule was that if we were going to be global, which Henry and George basically required, the golden rule was we are not going to cross collateralize our products or our promotes. So we are going to have independent strategies that function as independent satellites spinning in each part of the world, appropriate for different parts of the capital structure. Now, there are two reasons for that. One is the economic reason that we wanted to diversify away our risk in terms of how our economics are created. So not fall into what I would call the the MESREF or the Whitehall problem, where these big global funds took down the whole franchise. And two, to allow us to give our LPs the agency to portfolio construct their own exposure to real estate by geography and by risk return profile. And that would allow us to have a more continuous and regular dialogue with our LPs, as opposed to, raising a big, global fund, every 4 years and not having to stay relevant in front of your most trusted LPs within those 4-year timeframes. When you're in the market, literally constantly, with the opportunity for LPs to invest in one or more of our products across this global footprint, it just makes it a much more relevant and important thought partnership.
Mhm.
So now I'm going to answer your question. Because we are designed the way I just described, we are active in every one of these markets as an equity participant, and in Europe and Asia, in Europe and the United States as a credit participant. In Asia, we're not in the credit business. And that activity may or may not result in a lot of capital commitments based on the attractiveness of the opportunity set at any given moment in time. So for example, in the world that we're all living in right now, I would say 90% of all of our capital committing in this year, this calendar year, has been in real estate credit. So even though we are actively, analyzing and bidding on equity transactions all over the world, we've originated as a loan originator or a purchaser of secondary market real estate credit about $12 billion worth of stuff. In our global equity franchise, opportunistic and core plus, added up all over the world, in terms of equity committed, less than $2 billion. Okay? And why is that? It's because we're looking how risk is pricing all over the world, and we're looking at how the banks have exited the lending market and how the securitization market has closed up in the last 8 or 9 months. And there aren't that many people in the world who can go and originate credit in the size that we can play in. And we lend to our biggest competitors because the banks aren't lending to them right now. So that's a long answer to a short question. But in the spot market today, the best risk return is in real estate credit in the United States and in Western Europe. And all the equity markets, I think the bid-ask spread is still pretty wide, and that's why you don't see a lot of transaction activity.
So it's a combination of the opportunities on credit and the pricing has not yet adjusted on the equity side.
Correct. I mean, I'll give you a simple example. Blackstone took private ACC. We ended up buying in the single asset, single borrower securitization of that capital structure, the 44 to 47 piece of that capital structure at 9.21%. Okay. So that's a pretty compelling risk return with basically 53 points of subordination below us to participate in a high quality asset base with a great sponsor. We do a ton of business with Blackstone, but it just feels like that's like the best risk return that we could find in the market. And so that's we go and do. So that would be like representative of like why we're behaving the way we're behaving.
And given your mindset that you don't mind being in equity if the pricing is right, is that part of how you think about the exit strategy? Or do you think, like, what is the term of some of these loans and what's the exit if the credit markets stay as constrained as they are?
Well, as a lender, we now have built our own special servicer, and we have our own, surveillance and monitoring, group internal, and all the loans that we originate, for the most part, are floating rate loans, and we do that on behalf of 4 different pools of capital. We have a publicly traded mortgage REIT, KKR Real Estate Finance. We control the real estate balance sheet exposure of Global Atlantic, which is sort of KKR's like Athene equivalent in the Apollo context. So we're a 65% owner of a $150 billion insurer. And so all the real estate exposure, I'm responsible for, and most of it's credit. And most of that is actually floating rate credit. And then the third pool of capital is we have a closed-end opportunistic credit fund that we created to take advantage of dislocations like we're talking about in the marketplace. And then we have a democratized REIT, a private REIT, like our equivalent of a B REIT or S REIT. Mm-hmm. And in our private REIT, we also create credit exposure. So those four pools of capital are participating actively, in the credit markets, but the same team of people is responsible for, sourcing, structuring, surveilling, asset managing our credit book. And if there's a problem, we have asset managers on the equity side of the house. We foreclosed in one instance already, and we take equity ownership, and we're in the workout business. So
it doesn't scare you because
no,
you have different pockets and different.
Plus, we don't have, because we're effectively a shadow bank, entity. We don't have the same risk-based capital, constraints over how we think about behavior of our own risk appetite to, to foreclose or to, make something non-performing. As you guys know, because you're experts at this. Sometimes banks are more interested in, restructuring and extending so that they don't trip risk-based capital barriers.
So how about, before we drill down into some more details, how about inflation? How does that factor into your investment strategy now?
Yeah. So inflation is both a good thing and a bad thing for our business. The obvious good attributes of inflation are if you have the right product in the right market with the right demand drivers, your ability to sort of pass through inflation is very real. And in my business, I think in all of our businesses, the game is to be able to grow rents or net operating income at a faster rate than CPI or inflation. That's the game. So in all things housing and self-storage and student housing, senior housing, single family for rent, multifamily, industrial, there are lots of sectors that we're all exposed to where inflation is a good thing because the demand drivers are real and we're marking to market rents at significantly higher rates than you're seeing in terms of inflation growth or relative to inflation growth. The second, obvious place this plays to the strengths of real estate landlords is that it makes the barriers to entry very high, as we all know, in terms of replacement cost and with respect to wage labor, as well as commodity costs to build new product. So those are the good things. And by the way, you can also pass through, in most instances, your expenses to your customers or tenants in terms of energy inflation or even tax inflation, if you want to call increases in taxes inflationary. On the flip side, I think it would be naive for anybody in the real estate industry to suggest that inflation is only a good thing, because the negative element of inflation is what we're observing right now, which is the desire on behalf of the Fed to effectively slow down economic growth, and in doing so to raise the risk-free rate, and also not unintentionally increasing the heightened risk of a recession, which widens credit spreads. And so that's all maps back to effectively inflation, in my view. And so you can't be naive in suggesting that we're going to be able to pass through great rental increases at the same time that the Fed all of a sudden decides to start lowering rates. That's not going to hold true. Mm-hmm. The day that these guys start lowering rates, is the day that I'm not passing through increases in rents. In fact, I'm probably losing, occupants in a lot of what we own. So, and then the last thing I'd say on inflation, by being a floating rate lender, obviously the SOFR curve effectively reflects the expectation on inflation in terms of the shape of that yield curve. And so you're basically, directly benefiting from inflation as a lender if SOFR continues to increase.
Very interesting. So on the equity investment side, Greg's been looking at your aggregation strategy, and we'll get to that next, Greg. But before we do, you did something that seemed unusual for your real estate practice recently. You bought a REIT, CyrusOne. You took it private. How does that fit into the strategy, and can we expect to see you doing more of that?
Sure. So everything that we do in the world, even though we have like this opportunistic, 007, mandate in terms of like how our funds are constructed, most everything we do maps back to a theme. And the theme that we are expressing an opinion on is typically related to something around demographic pattern shifts, something around consumer behavior trends or shifts, or something around how companies either manufacture stuff, distribute stuff, or how those companies interface with their own employee base. So everything we do maps back to one or more of those buckets of themes. So to your question about CyrusOne, we had a thematic view as a firm, not just within real estate, but in connecting the dots between real estate, infrastructure, private equity, our tech teams in private equity, our growth equity teams all over the world, that we just had this view that the demand for data and the inability to access power was going to continue to combine to make the data center sector a scarce real estate commodity that would continue to increase in value, just generally speaking. Now, there are market by market nuances, but that's sort of the high level theme. And then you sort of say to yourself, okay, how do you express that theme? Now, as you all know, it's very time intensive and cost intensive to develop a data center. And once a data center is developed, it sort of becomes a core asset, immediately. And therefore, only a core buyer would be the buyer of a developed, data center. So, and the third most important attribute probably is that because it's so difficult to develop these things, it's really hard to aggregate and create a lot of scale. And when you're running, 65 billion in real estate AUM, and the firm also runs about 55 billion of infrastructure AUM, and you have an asset class like I've just described at the intersection between real estate and infrastructure, and it's really tough to do like in an organic growth kind of way. You sort of put this strategic acquisitive hat on, and you end up, making a bid and taking private a company like CyrusOne. So I think it's representative of what we're capable of doing. I think you have to really make a list of all the attributes that I described to sort of show why it was compelling for us to, by definition, pay a premium to a market clearing price to, gain control of a public company. So it's a component of our toolkit, but I don't think of like public to privates as like a thematic strategy of ours. I think it's one way to express access to a theme under the right circumstances.
Interesting. So it's not a wholesale to retail strategy. You're just going to buy stuff.
No, not at all. The opposite. No, we've got people, we've got this global team at CyrusOne. We're developing lots of emerging markets, and it's a lot of it's leveraging the tenants that you have and moving them all over the world. And there's a big, value to that.
You keep that business and just grow it. You use the
Correct.
platform to grow.
My instinct is we'll probably take it, one day it might go public again.
Right, right. Okay, Greg, aggregation.
Yes, thank you for giving me the floor, and thank you again, Ralph, for being here. And I'm super happy to be a part of this. But yeah, on the point of aggregation, I was actually reading an article that was published through Pair, and when I was researching KKR and what you've done since you joined to the firm, I thought the trajectory of where you came in to where the business was to where it is now and how it got there was incredibly fascinating. And so this article that was published through Pair this past February entitled "How KKR Reached Scale Through Aggregation," and it detailed a lot about how the firm has tripled its AUM in the past few years and the important role that fragmented property types have played in this. And then moreover, it noted that after launching its first fund in 2013, as you mentioned, KKR was more or less priced out of some of the largest cities and the biggest trophy asset classes. And instead, it looked for opportunities where it would face less institutional competition. And those were in asset classes such as student housing, senior housing, SFR. And you were quoted, sorry to put you on the spot, saying that the key to reaching scale in real estate has been aggregation, and that every week you were probably approving 5 to 10 acquisitions, noting that most single asset transactions are valued at less than 50 million. And so the byproduct of targeting these niche assets in non-gateway cities. And then individually, they are smaller and less high profile. And so you mentioned that you're playing the long game to build a diversified collection where the sum is greater than the parts. And so the question that I had was that now that your portfolios are maturing, the scale of the business is much larger and exits might be more of a viable option, obviously dependent on market conditions. How has your macro viewpoint changed on your overall strategy?
It's a great question. And it's a little bit subtle to understand the answer, but the simplest way I think about it is if you go back in the history of our industry, any major global player that wanted exposure to commercial real estate starting in the 1980s, certainly when I started in 1986, the way they got that exposure was either through the office sector or the retail sector. And why is that? Because transaction sizes were big, and so it was efficient. And secondly, up until 7 or 8 years ago, those two pieces of the real estate ecosystem, office and retail, were the most defensive in terms of demand drivers with respect to predictability of tenant demand and also high barriers to entry. Okay, so I point that out as an observation that the world was underweight when we started the real estate business at KKR in 2011. The world was underweight everything other than those two asset classes, and therefore we weren't like crystal ball guys. The reason that we went after all these fragmented asset classes was because we felt that at some point the world was going to want to diversify away from office and retail and gain exposure to all other things that are real estate, where the demand drivers are much more predictable than people historically had ever understood, based on a data-rich, world that we live in and a technology-driven world. So when Rob and I started this business in the 1980s, if you wanted to go buy a building, you had to get on a plane, you had to go spend 2 weeks in Cincinnati and figure it out. Or when you wanted to buy non-performing loans from the RTC, you had to go live in Miami for 2 months and figure it out. The five of us can basically underwrite a deal almost anywhere in the world from this Zoom and get enough access to information and data that we come pretty damn close, other than doing a physical inspection of the property. Okay, so we always felt that with a blank sheet of paper back in 2011, that if we started getting exposure to these other things, that one day the institutional investor would accept all these other things as being important to their portfolio construction. And then you take that to the next logical continuum. Well, how are you going to get access to these other things? Because as you point out, I guess in my quote, these other things are small, unless you do an episodic deal to buy a big portfolio of assets, which again, isn't a strategy. That's like a tactic, right? So the way we went at it was to build our own dedicated verticals in each of these fragmented asset classes that we can control, and that we can, sort of move stage left or stage right to focus on the markets that we want with respect to that particular asset class representing one of these particular themes. Then add on top of that, holy cow, like we woke up and these two major asset classes, office and retail, got dramatically disrupted basically since I've been at KKR. Technology has changed those two asset classes dramatically for the worse. We can all debate, work from home and whether or not it's a good thing or a bad thing, it doesn't matter, right? Technology has allowed corporates to become much more efficient with their footprint, even if they have a work in the office culture. Because with technology, you need less space. I mean, obviously, the law firm, you don't need, stacks of, you don't need a library anymore. I mean, there are lots of examples of how technology has reduced the need for a footprint in a office context. And then you add on top of that, there's work from home debate. And obviously retail, we don't all have to, state the obvious, but we all know that technology has dramatically disrupted the need for physical bricks and mortar retail. So now the world of this institutional investor has gone, holy cow, like I was overweight all this stuff. My game plan was to continue to diversify away from this stuff, but now I really got to diversify away from this stuff because every day I hold it, it's losing value, not gaining value. And we're in an inflationary world, and that's even worse because it's losing value in a world where inflation is also killing me. So all of a sudden, all these things that we have are becoming more and more valuable just in terms of how global capital flows work. And by the way, lenders aren't dopes either. The cost of capital to finance all these other more consistent demand driving product types is much more efficient and cheaper than the capital to finance the stuff that's effectively uncertain in terms of demand drivers. So that's sort of the answer to your question. I'm sorry it took so long to answer it.
No, that was great. And just to piggyback off that, I'm curious, while you were going through or while you've been progressing through those years from 2013 to now, and I guess more in those early stages, 2014, 15, 16, when you were maybe early into the student housing and senior living facilities, SFR, did you see other firms at the scale of KKR moving into those diversified asset classes, or did you guys see yourselves as the pioneers into?
Not at all. I think it would be somewhere between disingenuous and outright fabricating to suggest that we were a first mover. Listen, Blackstone is in lots and lots of these businesses. You got to give a lot of credit to Harrison Street, who basically founded their business on this premise that they might have diversified a little bit, but their entire business was really senior housing, I think student housing, and either multifamily or self-storage. I mean, they built their whole platform around these fragmented asset classes, and you got to give these guys a lot of credit for doing so. I would say where we might have like on the margin differentiated ourselves is really coming back to like working across the firm with private equity and global macro and credit and our public affairs team, and lots of people who have different views on what the long-term demand drivers are that influence demographic patterns and consumer patterns and how corporates work. That was probably the most like strategic input into how we decided the sequencing of what we set up and where we set these things up. And then you also have to remember also, I'd say a competitive advantage for us maybe not versus Blackstone, but versus literally anybody else in the industry, is that because we come from an operating corporate PE history, internal to KKR, we have like literally an entire suite of people who are in the business of like building operating capability for a company. So we have like the equivalent of like, Booz Allen or Bain consultants that are part of KKR, who literally their whole business is to like build out platform technology, build out pricing tools, create insurance programs, create employee benefits, lots and lots of things that you need to build like any one of these 14 vertically integrated platforms. They're building companies, right? And so you have a huge advantage to like plug and play into that whole suite of talent at KKR.
Yeah.
To get the scale that we've achieved in the time frame that we've achieved. That's really an important point, because we started, you pointed out, we started raising money in 2013. So we had no AUM in 2013. Okay. It's 9 years later, around $65 billion. Like, the only way that's possible is through all the benefits of the franchise, the capability that I just mentioned, the global footprint, the reputation, the relationship with the Wall Street firms and intermediaries to access deal flow, the balance sheet to be able to spend the money to build out a team of 160 people and to buy Global Atlantic and to buy an asset manager in Japan and to build a servicer. I mean, you can't just, if I had done this on my own, I'd have like, $462 million and, I'd be working, from my garage or something. I mean, you guys cannot, nobody should be confused. This is all about, the thing we did really, really well is we took all the attributes of KKR that I just mentioned, and we built a culture that leveraged all those attributes and sold that to our most trusted LPs, that we could really help them in the real estate space. That's really where I think that, not me, but my team deserves a credit. It's not that we did anything innovative in the real estate business. That would be like super disingenuous.
Fascinating. Scott, Adam, anything for you or from you or Greg?
Yeah, I want to come back to the support theme. There's a whole thread there about role models we can get into, but if we go back to your thematic discussion, we've been through a very volatile 3, 4, 5-year period. I mean, even the year before COVID was starting to look like a recession. We went through COVID. Now we're going through, all sorts of geopolitical issues and whatnot. Are these data points impacting or adjusting or causing you to adjust your thematic thinking, or is it really kind of solidifying, those major themes for you? Are there underpinnings of other themes starting to brew?
It's also a good question. I mean, I think in terms of like the long-term demand drivers that, that map back to these buckets, I think they've been mostly reinforced and accelerated through what we've all experienced. And then there's some like new twists to some of these themes in terms of the acceleration that are directly COVID and geopolitically related, like, for example, the onshoring boom in the United States with supply chain issues with China because of their COVID policy, and of course the geopolitical tension now with China. And that's like caused us to even put more accelerated focus on getting access to the best distribution facilities and the best locations, and front running manufacturing hubs that we see through our portfolio companies that might be more relevant now than they would have been pre-COVID. I would also say, Scott, that in terms of how we price risk, I would say that's the most the biggest pivot in this particular stage of the market evolution. Obviously, with the cost of credit being so high and uncertainty around economic growth because of the recession risk, all risk assets are repricing, unlevered discount rates are widening, cap rates are widening. In my models, at least, growth rates are slowing. So that probably be the most like spot market, impact on what you're pointing out in terms of like how we're changing our behavior. That's sort of implicit what you're asking me, how we change our behavior. So we've definitely changed like the aperture through which we are pricing risk. Certainly in Europe, the United States, Japan, I'd say is still on sale in my mind, because you can borrow incredibly efficiently and very low absolute rates, and you can gain 300 plus basis points of return through swapping yen for dollars. And so there's some idiosyncratic things about Japan that make that super compelling today. And then, as I mentioned, like being a lender is really the place that it's most pronounced in terms of like changing our behavior. But in terms of themes, accelerating the themes we like, and it's also accelerating the negatives of the themes that we don't like.
Got it. Which almost makes it a compelling acquisition environment if you think about it, right? You're repricing risk, fundamentals are changing a little bit. Broad market themes are becoming,
Yep.
more, solidified. It's almost a good opportunity to start aggregating more assets.
It definitely is. If I could push a button and be a multiple money investor and not an IRR investor, I would 1000% agree with you. Without at least neutral leverage or even slightly positive leverage, I think it's just really tough to make like a scale bet on creating IRR. That's not to say we're not being acquisitive, but that would be the one impediment to like why you're not like going all in.
Right. Got it. Thank you. Adam?
I was wondering, first of all, obviously, kudos. It's unbelievably fabulous story, and you do a fantastic job of presenting it. In terms of having, all these multiple pockets of investment assets and channels, is that present complication just internally in terms of which pockets get to be in things, different exit timetables, and how do you manage all of that?
That's great. Awesome question. Almost every one of our products has a very defined, exclusivity bucket that is typically defined off of a combination of return expectations and leverage constraints. So the combination of those two things almost allows you, without any much anxiety, to figure out like the appropriate home for an opportunity, because everything we underwrite, because my team is agnostic as to where these things end up, we can look at with 50% leverage, 60% leverage, 70% leverage, and we can look at it with a 7 to 10 year hold and a 3 to 4 year hold, and the math sort of almost informs you as to where the right home for something might be or should be. There are a couple of areas where there's an overlap of return expectations. That's typically in our democratized REIT and in our core plus funds. The private REIT has a 60% leverage target. The core plus has a 50% leverage target. The democratized REIT has a 5% dividend expectation. The core plus has a 3 to 4% expectation. So the way we've defined that is that in the United States, the core plus institutional fund has exclusivity over the top 20 markets in each of the products that it's interested in getting exposure to. So obviously the top 20 student housing markets are different than the top 20 industrial markets, for example. So they're different across that mosaic. And then the democratized REIT has effectively exclusivity on everything else. And in parts of the world where there's a little bit less of a fine line, Europe would probably be a good example, where core plus in Europe is more like our REIT product. In that situation, there's a rotation. So, the first look, asset A, if the core plus fund wants it, they get it, then asset B, the REIT gets it, and it's like being a managed account, a GP and rotating amongst
Mhm.
funds. But we've got lots of prophylactics to protect against the unintended consequences you're pointing out. But if this comes up once a quarter, it's a lot. It's less likely than you might think.
Yeah, it's an amazing accomplishment to have so many different vehicles and keep all these investors satisfied. Obviously, I'm sure the great returns are a big part of making that possible.
Yeah, well, I appreciate you saying that. I mean, we're very, very we're a public company. We have an audit committee. We have a risk committee. We've got, we're governed by the SEC. Our REITs, SEC, registered. So there are lots of guardrails that we have in place, appropriately so, to make sure that we're satisfying our fiduciary duty to all the pools of capital that we've raised, and that we're doing such as advertised.
So related question to that, part of this is being done through NYU's REIT Center.
Mhm.
How do you think about the REIT vehicle versus the fund vehicle? Is it just the source of capital, or is it a different kind of model?
Yeah. So when you look from above at the KKR real estate franchise, it really is a mini version of KKR Inc. We're global. We're in credit, we're in equity, we're effectively in the core part of the capital structure, either in credit or equity, and we're in the most risky part of the capital structure in our B-piece fund in credit and in our equity opportunistic vehicles. And all of that up until 2.5 years ago was all institutional capital. Okay. Now, a little bit back to Greg's question about are you an innovator? And I said, no. You can't help but have watched what Blackstone, started to create in BREIT, and with a lot of credit due as well, what Starwood created in the same channel, and that was all effectively non-institutional capitals, high net worth capital, and so. The obvious move that we wanted to make was to capture our fair share of literally a multi-trillion-dollar market. Now that Blackstone had effectively institutionalized that channel for all the reputable wirehouses, and we sort of observed that, and we said, okay, now we have to innovate. Now we have to come up with a product that makes us different from those guys. So we created a 40 Act product. And as lawyers on the call know, is more for Greg, the REITs are blue sky regulated. So they're regulated by each of the 50 states. When you have a 40 Act product, you're regulated by the SEC, and you have a ticker. We have daily NAV. It's point and click. You don't have to fill out subscription agreements. We have the ability to be on multiple platforms all over the world and literally take in money every day. And so those are all differentiators. And then there's some structural differentiators as well that help the distributors out in terms of how the fees work, et cetera, that are beneficial to the ultimate investor. Like, for example, in a 40 Act product, you cannot promote off of an unrealized gain. And so that's a big deal because our competitors all do that. And we only take promote off of income, off of realized income. So we created a differentiated product that allows a financial advisor at Morgan Stanley to look at Crest, which is our product, as either a complement to BREIT or as a substitute to BREIT. And by the way, importantly, there's another little nuance that the lawyers know, that there's a regulatory 8% limitation on your ability to own private REITs and effectively BDCs in a personal account. And that is governed by the states. and imposed on the financial advisors. Because we have a 40 Act REIT that falls outside of that 8% limitation. So it also makes it more flexible and user-friendly for people to add to their portfolio construction. So I tell you all that, Robin, to point out that we observed our competitors in terms of getting access to high net worth capital. We thought our brand and market position would make us very relevant in those channels. And then we created a product that we think is a superior product to what these guys have. And by the way, unlike our competitors, we have a portfolio construction that's 1/3 credit, 1/3 net lease, and 1/3 traditional, income producing real estate. And we have global exposure. Our competitors predominantly have income producing real estate in the United States. So again, another way to differentiate ourselves in terms of portfolio construction. And so that's where we innovated. And that I really do think is a sign of innovation after we observed the size of the market opportunity.
But Ralph, is that within the REIT, or that's across your whole platform in terms of those?
No, that's within the REIT.
Within the REIT.
That is the one product that we have, the one vehicle that we have, that is a global vehicle, and that's credit and equity.
How is it done? I hadn't realized how different it was from B REIT and S REIT. Is it?
Yeah. So we've been
going out.
Yep. So we've been up and running now for 16 months. We're up to $1.7 billion of equity. We're currently on several platforms, not all domestic. We haven't exported global yet, but we will. And on average, the inflows have definitely slowed down in the last several months. But even in the most recent months, we've been raising between 60 and 100 million a month. Now Blackstone was raising $1 billion a month. And and now they're facing redemptions or whatever. But I think they're doing really well, to be honest, as an observer. But we've got the other advantage we have. It's a little bit like when you're playing basketball and the guy you're playing against is 6'11", and you say your advantage is you're 5'8" and you can dribble around him. It's all relative, right? I mean, the advantage we have versus B REIT is it's much easier to portfolio construct and to pivot when you're $1.7 billion than when you're 55 or 60 billion.
Yeah.
So like we took our real estate credit exposure at the beginning of the year from 5% when it was like not that compelling to lend. And now we're 35%. So literally almost every dollar we've taken in the last 6 or 7 months, we've been originating credit. And so that's been like the competitive advantage, if you had to point one out, for being small. But anyway, so that's what's going on.
But no shortage of opportunities to put that money to work in credit.
Not today.
All right, Greg, back to you. I think we've got about 8 minutes left.
Awesome. Yeah. So I think maybe shifting gears a little bit, speaking as a fellow student and then speaking for a lot of my students at NYU, it would be a disservice not to ask about your journey, because I think myself, and I know for a fact, all of my other fellow students would agree that your journey and your career path is nothing short of exceptional. And so I think from, where you studied in undergrad to Stanford to your hedge fund in Goldman and KKR, with all of that in mind, what can you say have been some of the key attributes that have been, really influential and effective in getting you through all of those different stages and to where you are today? And what advice would you have for, myself and the rest of the student body that are looking to set off in a similar direction?
Well, it's nice for you to say all those nice things. I will point out for clarity, a lot of it is luck. And a lot of it is, I speak for the other members of this discussion, we all started in this industry at a moment in time where, interest rates were going down and cap rates were going down, and the institutional acceptance of commercial real estate was going up. and the world was growing, which required more real estate to, house and create products and all the stuff we've talked about in this call. So, like, you can't dismiss the fact that when you have a really great seat in the greatest expansion literally in the history of the world, you can do some things wrong and still do pretty well. So let's be honest. Having said all that, if I had to point to, like, even with those benefits, like, what do I think made a bit of a difference on the margin? I would say a couple of things. To do our jobs, you literally only need the math skills of like a seventh grader. It's really not a complicated business, okay? And I mean that sincerely. It's just sort of basic algebra. And so it's not that you have to be, a genius, but I do think you need to have certain skills and attributes that help create investable outcomes. Number one, I think, having EQ and self-awareness is like critical in any business, important to the real estate business because this is a relationship-driven transaction industry, including, how you interface with your counsel and who you want to work with and who wants to work with you. I would also say that being a very self-aware team player is an important skill that I think I've, utilized very well over my career. The first one in the morning, late to leave, willing to help out, reasonably calm under pressure, don't lose my temper, good sense of, I think I've got a good sense of humor. Listen, it's a people business, guys. And I think, students probably underestimate, personality and maturity and poise and all the stuff I just mentioned as not mattering, but all that stuff matters probably the most. And then the last thing I'd say is that, as George Robertson, Henry Kravis remind us almost literally every day, people like to be around and do business with people they like and trust. And that means having humility and pointing out mistakes and not, BSing people about the facts and, just being, working well under adversity and owning up to problem solving. And that's what, creates relationships over, decades, either with institutional partners of mine or ours, but also with people who I do business with and who I'm friends with. And so, I would sort of summarize it with that bucket, Greg, that, this isn't about what your GPA is or any of that kind of stuff. It's really more about self-awareness and self-reflection and the ability to be a great teammate.
Yeah, well, thank you. I know I really appreciate that. I'm sure everyone else will too. And I guess I don't want to ask too many questions,
Okay.
but just going off of that, in terms of role models, I always think it's really interesting when looking at, extremely successful people in different fields, and especially the fields that we're all looking to go into, who have been some of the people that have helped shape your thinking, your thoughts, the way you go about things. And if you could name a few of them and if they've changed over time, but anything that maybe you could add some color on there, I think would be really interesting to hear.
That's a great question. For sure, I point to a handful of people. Dan Neidick, who you guys probably know, runs Dune Capital. I worked for him, the day I went to Goldman out of college, and he was unbelievable in terms of, giving me a responsibility at a young age, trusting me, letting me sit in the room, for the big meetings and watching, how people, problem solved and, built relationships. And he's probably the most intellectually curious guy I know. And he sort of almost by example challenged me to to develop that that instinct or appetite. So I put Dan number one on the list for sure. I'd put Joe Schenker, who, as these guys know, you know, I don't know if he's still the managing partner of Sullivan & Cromwell, but you know, for most of my career, he ran the real estate business at S&C, and you know, he was basically Goldman Sachs's, you know, counsel, and he also, you know, taught me how to critically think and to problem solve, and you know, even as an analyst, treated me like, you know, a senior person with a view, and you know, every big deal I did, Joe did as my attorney or my counsel, which, you know, is to plug our attorneys on the call here. You know, a lot of these deals are created by the attorneys, not by the deal guys. So, you know, you can't dismiss Joe. There's a partner, former partner at Goldman, Barry Volpert, who now runs Crestview Capital. He was in the merchant bank as a partner at Goldman, ran all the distressed corporate investing. In the early days of my career, you know, I was responsible for identifying and ultimately, you know, leading the execution of the Rockefeller Center transaction and Cadillac Fairview. Greg, these are names that don't mean anything new, but you know, those two deals don't happen without Barry Volpert showing me, you know, how to, you know, force a company into bankruptcy, and you know, and you know, be a part of that. Obviously, you know, Robin will know this near and dear because, you know, Len Rosen, you know, represented us, and Jane Vriss represented us, you know, in the 90s on both of those deals, actually. So, you know, just incredible mentorship from a guy who really didn't have to do that, but
Yeah.
you know, it was part of the Goldman culture, and you know, and he taught me a ton. And then lastly, back to our industry, you know, it's hard not to point out Jerry Spire. You know, we brought Jerry in, Tishman Spire in as our partner in Rockefeller Center. This was back in 93, 94, 95. So I was 30, 31 years old, and I was running these deals, and you know, Jerry, again, treated me like a peer. I mean, he couldn't have been more deferential and respectful, and he really cared what I had to say, and he knew I understood the, you know, the numbers and the models and the stuff and the whatever. And I learned a ton watching how Jerry was able to bring some very important investors into that capital structure, including David Rockefeller and the Agnelli family, the Crown family, the Nyarkos family, and how Jerry, you know, architected the day-to-day management of Rockefeller Center. This was, by the way, when Rob was still in college. So, you know, this is a long time ago. And, you know, Jerry was nothing but awesome to me. So I don't know, there are probably 5 more behind these 4, but these guys are on the Mount Rushmore of my career.
That's really great. Yeah. Thank you.
That was fabulous. Unfortunately, we're out of time. I feel like we've barely scratched the surface. Ralph offered at the beginning to actually come physically to a class, and we're definitely going to take you up on that with the
Happy to.
REIT conference. This was truly fascinating. Can't thank you enough. Really appreciate it.
Well, listen, I really appreciate you guys inviting me, and like I said, happy to come down and see you in person. And you know, anything, if you have any questions or whatever, you know, you guys know where to find me.